Well, good afternoon. Good afternoon and welcome to another of our webinar Wednesdays, hosted by the Cal State Bakersfield Small Business Development Center. We're here today for webinar number 367. 367 as we kick off our 14th season of doing webinars. Thank you for joining us today. We're going to go through really a big question and a big thing that comes up at the SBDC, and that is on the borrowing side of things. We're going to go through a lot of the potential bungles, pitfalls, and we're going to have ideas on how to fix them to get loan approval. We also have a special look-in guest. We have SBA's Israel Lara Jr., and he'll be joining us in about 10 minutes for just a quick little focus on what is happening, some of the happenings at the U.S. Small Business Administration's Fresno District Office. So what is up today? Today, we are up to January the 28th. Boy, where is that no by January or that dry January, whatever you're doing this January? Maybe you're back at the gym working those resolutions, but we're about done with January. What is up today, January 28th? And we're going to go through making the loan process easier. We all know any type of capital formation, getting any type of capital is not easy. But we're going to try to make the process a little easier by cutting out some of maybe the steps that you make that are not going to help you in getting a small business loan. So we're going to get to that a little later in today's program. We're going to have, in a matter of a few minutes after our poll questions, a live look-in with SBA's Israel Lara Jr. We're going to jump into our economic corner. We had some late happening breaking news. So late, I didn't even update the slide. And that was, give a little of that away right now, and that is the Fed, after a couple of rate reductions, have halted that and kept interest rates steady at the meeting concluded about an hour ago. So on January 28th was the end of, I believe it was 2/4% rate reductions. And of course, why that's important, we'll discuss at Economic Corner. We also have some news and info and other resources. We're going to try to provide you with a great deal of resources to help you and to help your business in order to obtain these funding sources. Also, we'll talk on our Capital Quarter, which is a regular feature in addition to Economic Corner. And that'll talk about a little bit of uncertainty times, but it's going to talk mostly, and we're going to really feature those bungles and pitfalls in order to avoid those and to get small business funding. We will take your questions. We always take your questions live after the presentation today. So if you have a particular question you'd like to ask, feel free to jump into either the chat box. We'll go to the chat box, or also generally under the More feature, you can find the Q&A box. So they might do a good job of hiding the questions, but we will check both the Q&A box and the chat. And a lot of our other online resources and resources we discussed today will be immediately available to you via our chat box, courtesy of our webinar producer, Maureen Busherdang. And we have a poll today. So let's get with our poll today. A few different questions that we're going to jump to on the particular poll. But one is just kind of a little market to research for us and for me today, basically. And what we're going to ask is if you're seeking funding, if you want a small business loan, ideally, how much would you like to borrow? And is that going to be over $1 million? Is it going to be 300,000 to $1 million, 50,000 to 300,000, or 50,000 and less? You know what we find, and we ask this question a lot, oftentimes of our advisors, it's the first question out of their mouth. Is if you are wanting to get a small business loan and funding, what size would you like to get ideally? And oftentimes we'll talk about ideally what you would like and then what you would need to get the business going, which could be two different amounts. But right now we're just asking how much would you like to borrow, and jump in, last call, 50,000 or less, 50 to 300, 300 to $1 million, or over $1 million. So we do have about 52% of you participating, and we are coming down to the wire. Going to allow you one more moment to get that last vote in. And then we are going to end the particular poll on an even number. Wow. And with 50%, or excuse me, 64% of you, we will share the results, and 45% of you are looking for 50 to 300,000. 18% is a tie between the rest of everybody else who wants 50,000 and less, 300,000 to a million, or over $1 million. But nearly half of you, 50,000 to 300,000. So thank you so much for that. Our second poll question today is going to be on what do you think lenders care about the most? So, what is your perception when you go to get a particular small business loan? Do you think they care most about your revenue growth, your net profit, your cash flow after debt service, or also the collateral value of what you're securing? Okay, four things that a lender is going to care about. Uh, I think lenders might even have a different answer for this as well, but just kind of a good little poll question on perception. And what do you think? What do you think lenders care most about? Is it revenue growth, net profit, cash flow after debt, or collateral value? So we'll give you a moment to participate and to get through that particular question. I think on a question like this, it's very difficult to answer because, there's a lot of different lenders that have different opinions on this, but a couple of them stand in my opinion that I'll give you in just a second. As we give you the last couple of moments to end the poll, we're going to end it right now. And we got a tie for first between revenue growth and collateral value, 31%. Your cash flow after debt, 23%, and net profit, 15%. So if I'm taking this particular poll, I would probably go with the 23% view that went with cash flow after debt. Most lenders that we talk to say that they are cash flow lenders. So they are most concerned with cash flow from operations of your business, being able to satisfy your debt payment, your new debt payment for the loan that you're taking out. But obviously, they're all very important. Some are collateral lenders, and and others will take and have a lesser requirement on collateral. Net profit, obviously, profitability and showing that is important, but I don't think near to the extent of cash flow. And also, it's always good to have that revenue growth and also moving in that direction. So we will move on to our last poll question today. And after that particular question, why wouldn't I ask a question about cash flow? How confident are you in your ability to explain your cash flow to a lender? So, how are you? How confident are you? Very confident? I'm somewhat confident, not confident, and I've never been asked. Four choices. So, my opinion on cash flow is the most important of the last question we ask. How confident are you to where you can sit down with some financial information, historic if you're an existing business, maybe it's projected information and projected cash flow if you're looking to start up a business? So, how confident are you that you can explain that? Okay, we have 57% of you participating. We're going to give you another moment or two to jump in the poll and share the results with you. And not confident is 42% of you. So not very confident. And, we're going to tell you today that that's important in being able to discuss the whole entire financial projection before you present to a lender. So 42% not too confident, 33% somewhat confident, and 25% of you very confident. So thank you for sharing your opinions on our particular poll questions today. And let's move along. And today we're happy to bring in Israel Lara Jr., who is with the U.S. Small Business Administration. Israel, please join us and take it away.
Thank you. Thank you to you and Maureen for allowing us to participate this afternoon. Good afternoon, and thank you for inviting the U.S. Small Business Administration Fresno District Office to today's webinar. SBA is happy to join Kelly and the CSU Bakersfield Small Business Development Center in today's webinar. As a resource partner who has done remarkable work in Kern County and in the areas that serve small businesses, their efforts have shaped the Kern County economy and small business growth. I would like to announce some remarkable initiatives the U.S. Small Business Administration has been implementing and upcoming events that the Fresno District Office will be hosting in 2026. In 2025, the U.S. Small Business Administration launched the Made in America Manufacturing Initiative. This initiative was updated in 2026 to strengthen U.S. manufacturing, support small businesses, reduce burden regulation, boost economic security. As part of the Initiative 2026, SBA created a Make Onshoring Great Again portal. This is the pathway to identify suppliers, manufacturers across the U.S. to meet your business needs. Onshoring portal gives small businesses the tools to lead this industrial comeback. The tools make it easier to find U.S. organizations, reduce overseas exposure, bring production back where it belongs. This supports American workers, revitalizing local communities, and rebuilding our economic independence. SBA's partnership with the local business development centers throughout the country is a key resource to help businesses get the help they need to grow, navigate regulatory requirements. This free SBA tool helps connect businesses with verified U.S. manufacturers, producers, and suppliers. It's built to support companies that want to onshore operations, strengthen their supply chain, and source the components they need, all proudly made in the USA. Secondly, SBA, in partnership with the Office of Advocacy, is working with small manufacturers on the initiative Cutting Red Tape for Small Manufacturers. You can find more information on the Priorities tab on the SBA website. Cut the Red Tape was created to reduce federal rules that slow your business down. If you face challenges, tell us about them. The Red Tape Hotline gives you a direct line to report burdensome regulations and shape smarter policy. Thirdly, the SBA in 2026 has deployed loan programs that help small businesses and manufacturers meet high production demand. This initiative removes barriers for small manufacturers, expands access to SBA loan programs like the 7A Manufacturers Access Revolving Credit, which we call the MARC, the 504 loan, and the 7A Working Capital Pilot. The funds training partnerships and opportunities to build skilled workforce through SBA's Office of Entrepreneurial Development. The SBA works hard to help small businesses start, grow, sustain, and employ. The maximum loan amount for a 7A loan is $5 million. Key eligibility factors are based on what the business does to earn its income, its credit history, and where the business operates. Your lender will help you figure out which type of loan is best suited to your needs. And lastly, the SBA continues to work on expanding and developing entrepreneur initiatives that promote economic growth and help small businesses. Created in 1953, the U.S. Small Business Administration, the SBA, continues to help small business owners and entrepreneurs pursue the American dream. SBA is the only cabinet-level federal agency dedicated to small businesses and provides counseling and capital contracting expertise as the nation's only go-to resource and voice for small businesses. For more information on SBA products and services, please contact your local resource partner or the local SBA district office. As a final reminder, the Fresno District Office is hosting a webinar on Thursday, which is tomorrow, January 29, 2026 at 10 a.m. on how to fund manufacturing. And today, Kelly's going to talk a little bit more about funding. Please email the Fresno District Office at fresno@sba.gov for registration information. Please follow us on LinkedIn and Eventbrite for our Manufacturing Series webinars for 2026. Please join us and Small Business Development Center in celebrating National Small Business Week, which starts on May 3rd through the 9th, 2026. Please contact the CSU Bakersfield Small Business Development Center for local events for National Small Business Week 2026. Thank you, Kelly.
Israel, thank you. It's great to hear about all the great new initiatives and programs, particularly in manufacturing, where I think we haven't had a great deal in the old tool shed the last few years. So, and it's exciting to hear the webinar. I think Maureen will have something in the chat where you can grab that and go from that. And the SBDC and the webinar Wednesday program is going to have some more stuff on manufacturing coming up too. So great to have you on. Thank you for joining us. Welcome back, by the way.
Thank you.
One of the things that I want to talk about, in addition to our interest rate hikes with webinar Wednesday's Economic Corner, there's a few other things, but today it was mentioned that about an hour ago, interest rates held. And why is interest rates important? We talk about this quite a few times, but variable rates are tied to so many small business loans and so many loan indexes that when they go down, so does your interest rate and your loan. And plus, it also on newer with lower interest rate, it will actually make it easier to cash flow a projected deal or a startup loan. So that is why we talk quite a bit about interest rates. And today they held steady. Some of the other things we like to talk about what's going on in the economy. There's some things that happen in the economy that kind of are tells toward what's going on with smaller businesses. We're starting to see larger companies with layoffs. And layoffs are continuing for larger firms. We've seen this week alone, UPS and Amazon announced more layoffs. Amazon's was for corporate level jobs. I believe this was the second installment of 30,000 jobs that they've eliminated. And then also Pinterest had a big layoff of about 15%, where they did some cost cutting and also some redefining roles utilizing AI and other tools. One of the things that we really watch since our economy is such a consumer-driven economy, and it is really important of the contributions that consumers like you and I may do. I mean, we make up the entire economy. So consumer confidence is important because when consumers are confident, they spend more money in the economy, which helps economic growth. And we see that dropping. And I found it kind of interesting. We found an exact opposite of what was happening with small business optimism, where the level of consumer confidence dropped from December to January. We have been seeing small business optimism continue to rise. That, of course, is the index that's provided through the National Federation of Independent Business. So by seeing that, why is that important? Well, one reason it's important is that what happens is that small businesses actually will do better when they are and expanding when they actually uh, are growing. So that's an important aspect of what's going on. So um, small businesses, when they're optimistic, they are more likely to expand and grow is the main financial. Okay, some of the resources that are going on and continue to go on. One of them is our AI solution in 2026. Here at CSUB SBDC, we are doing a lot and we have student teams, experienced senior level advisors, and others that are coming together to support our activities in AI. We have some great projects. We'll be announcing some of those later, but if you want to be involved, if you want your business, some of the things that we're doing right now are we're starting a new program that's in the restaurant industry that deals with a lot of food and hospitality businesses. Doesn't have to be food, can be hospitality, lodging, and others. But what we're looking at doing is we're looking at using your point of sale system and the data that comes out of that, and then using in AI to enhance greater greater information and data for decision-making purposes for the owners. So contact me if you have any interest in that particular program. Also, on our community calendar, what we have is we have coming up for you some free tax preparation through CSUV and the VITA program. And the VITA program offers free tax assistance for those in need and those needing assistance. Generally, those are going to be 70,000 and under. I don't really know if they jump into business returns like with the Schedule C and others. So I don't know if that's actually happening, if that's the case, but hopefully they either are, or you might know of somebody who could benefit from having free tax preparation from the VITA program. So moving along, we also have our tools, our SBDC tools to help you and your business succeed. A lot of different tools that we have that work with small businesses. We're going to generally focus on the ones that we utilize for those individuals getting small business loans. But outside of that, we have several tools on this particular page that can assist you. Everything from a generational transition plan to our quality risk management handbook. Really, what's been happening in the risk management field, insurance, liability insurance, all types of insurances. There's some really good strategies that are out that are mentioned in the quality risk management field book. So it's a field book, not a textbook. It's a field book that really helps professionals and helps business owners identify and really figure out ways to cut their insurance cost. So those are a couple of them, but more so, we also have our business planning platform, which is through LivePlan, and we use LivePlan at the SBDC for our clients. If you go through LivePlan, it's a subscription-based software and it costs you money, but we are able to provide you access to it for a limited time while you work on your business plan. Not a lifetime guarantee with the old good old life plan, but by able to producing a business plan that documents and generally talks enough about your business and also about the financial aspects of your business. And again, getting back to how you're going to cash flow, vitally important. So your advisor at the SBDC can work with you through LivePlan and work remotely in those particular areas. One thing you're going to hear me talk about today is the impact of your industry has on lending. So a lot of lenders, they might focus or they might mention that, obviously your business is important, but it might be news to you to find out that your industry and what's going on in your industry. We're seeing quite a few industries that are, I wouldn't say in peril, but they are having less than stellar results. And you could get into areas to where you have lenders that are unwilling to lend into specific industries. So every, lender has their different appetite for risk and their different analysis that they look at. But looking at your industry is vitally important. And so we encourage you to work with your SBDC advisor on Vertical IQ. And that is an industry-based database that will compare your financial results through your financial statements, your profit and loss, and your balance sheet. They will compare it with the industry that you're in based on either your SIC code or most likely your NAICS, your NIICS code. So in order to do that, you just have to work with your SBDC advisor anywhere in the Central California region will work. We all have access to Vertical IQ, and it's a wonderful tool for analyzing how your business is doing in that particular industry. Last but certainly not least is our YouTube channel. And there is our YouTube channel from a little while back. We are happy to say now that we have 520 subscribers and growing. It's a great way to get this particular content on a flexible basis, on demand, and you can just go and subscribe. But really what we've built there is we've built over 320 videos, many of them Webinar Wednesdays, and really just a great resource for going through for local information that is really fitting local businesses in our Central California SBDC region. So by that, a perfect example was yesterday. We had a gentleman who was looking at potentially selling his business. And so off he went to see the Sell Your Business webinar, most recently by a good friend of ours, Michael Ballstadt, from just about 4 months ago. So it's a great place to start and get that information. So our YouTube channel really helps us. And really, to benefit from a lot of those resources, you can sign up for confidential, no cost obligation, no obligation expert consulting. Go to our website and sign up. And remember, here at the SBDC, our services, almost all of our services, and exclusively all of our services, I like to say, are what I like to say free, 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 free. Okay, moving on today with our presentation today. We're going to jump into our capital quarter today, and we're going to really discuss and get into a lot of the pitfalls and mistakes that borrowers will make. And, small business lending is not an easy area. It's difficult. It changes rapidly. Lenders might change rapidly who we deal with. We could be dealing with a particular lender, and all of a sudden their focus changes. Maybe their appetite for risk, maybe a lot of different factors. So, really having a lifeline and kind of a direct communication with a lot of lenders, it really keeps us and really seeing what our clients do. It really keeps us up to date with what's happening in the accessing capital arena. So with that, here's a few little statistics. We mentioned the Federal Reserve keeping interest rates the same. Also, the Federal Reserve does a small business credit survey. Many of you might have actually responded to the survey this year or the last time that we did this. And oftentimes, if we get a large enough group, we are given our own subset of data. And so, just a couple of slides I want to share with you right now. And because, some people don't apply, and we always like to know why they don't apply, or if they have a capital need and they don't want to apply. Almost half of them already has sufficient funding. But then we jump into others that are discouraged for some way, shape, or form. Maybe it's the process, and maybe it's not knowing how actually, it is actually laying out as far as the decision to get a small business loan. So we have that working for you. There's a lot of people are debt adverse. They don't want any debt. The application process was too difficult or confusing, 7%, or the credit cost was too high. So those are reasons for not applying. I think it's always important to look and see why people don't want to apply for loans, in addition to those that have outcomes that did apply. And that's what we're sharing with you now. And so what we see as far as you see our region, our CSU SBDC region, the blue, shows that 40% of our respondents had no successful outcome compared to 22% nationally. So, um, so that's a good indicator of things that might be going on. And in this was one of the lesser replied to questions, um, but it really kind of shows you a little bit about the outcome for loan lines of credit and merchant credit accounts, which we, of course, don't recommend at all at the SBDC during the prior 12 months. Also, we have a few businesses that were, um, you know, we're going to go through now the top five, and when I say the top five areas that businesses have. And first, we're going to start with those that were just missing outside of the top five. And these are reasons why people had problems obtaining a small business loan. So, what are some of the biggest bungles that they have? One of them is, of course, not having a strong use of funds statement. And by use of funds statement, what we're asking borrowers to do is if you say want one of those loans between 50,000 and 300,000, is to be able to document how you're going to spend that money. The banks are going to want to know. Some banks go as far as, a lot of banks will cut you the check for that amount. Some of them offer it to you in draws as you actually purchase or spend the particular loan proceeds. So it depends on the lender here. Um, some lenders will do a reimbursement, so it's really kind of different and different per lender. But one thing that is consistent is that you really need to have a strong statement and strong use of funds and how that's going to work in the overall expansion of your business. So the bungle is asking for money without demonstrating how the funds will be used. A good example of that is maybe part of your, say, $300,000 loan request is going to be for working capital. Maybe you want to include advertising. Maybe you want to hire employees. Maybe there's some things that you want to do in order to improve the operations of your business. Well, some of those could be considered working capital, and it's really best to break them down. You know, it's always, in at least my opinion, much better to have a specific purpose breakdown of how the funds are going to be used rather than just the general ask. So lenders generally what they're going to want is they're going to want a detailed list of what is being purchased. But in addition to that, there needs to be a good explanation on why you need it for your business and why your business is expanding and growing and why you need that particular funds. If it's to potentially recoup maybe a downtime period, maybe you had an extenuating circumstance in the business to where sales drop, or maybe your cash flow was poor and you're looking to recover from that. It is also good to do that as well. But really, it's the lenders really what they only want to see is the efficient use of those being accessed. An important topic, but not in the top five. Not in the top five either is understanding the collateral or security issues. Lenders vary by collateral and how much collateral they're going to take. Oftentimes, that's going to be impacted by the size of the loan. It's going to be impacted by the borrower, because we deal with both nonprofit lenders and we deal with for-profit banks and other established credit institutions and traditional sources, in addition to a lot of alternative sources. So the collateral differences are going to vary. The standard over the life of my existence at the SBDC, it has been essentially 1-to-1. So if you want $300,000 worth of actual loan amount, you have to pledge $300,000 worth of collateral. So that collateral can come from a variety of different issues. It can come from businesses already accumulated in the assets and or assets already accumulated in the business would probably sound a little better. But really, it comes down to if you're purchasing some, for example, equipment or land or building for a particular expansion, then those are going to have really strong collateral values with the money that you're borrowing. So it makes it a lot easier. But if you're going to working capital and you're going to other uses, inventory, we see a lot of leasehold improvements and furniture and fixtures. Those don't carry as much or any collateral value at all, and it makes it difficult. And remember, there are some loan programs where collateral is not the key point. They will do less collateral. So collateral is going to vary by lender, but really, you know, it really is a pitfall if you go into a situation looking at it and assuming it's optional and the lender is only going to potentially want you to actually provide security or collateral. So in addition to security or collateral, oftentimes you'll be asked to personally guarantee the loan, which you are personally pledging a guarantee that that loan will be repaid. So that is important to note as well. You heard me talk about industry. I really do like the fact that we're getting many more of our small businesses interested in how their business pertains to the industry because your lender's going to care and they're going to care big time. And so ignoring some of the industry risk factors is that, you might have a unique business, but the lender reality to that particular misconception could be that industries are tiered. So there's going to be levels of risk depending on how your business is faring in that particular industry. And there are industries that are going to have much higher risk and is going to make it harder for a lender to approve that particular loan. So some of the industries that we see, and again, this is going to, everything varies by lender. Okay. But these are generalities that you see in the industries that are out there as far as restaurants, construction, some retail right now, trucking and startup face tighter scrutiny. Now, again, you face tighter scrutiny, but that doesn't mean that there are deals that cannot be done in those particular industries. For example, if I wanted to have a startup trucking business, and what I would want to do is I would want to be able to convey to my lender how I am going to get my loads, how and efficiently I am going to manage that aspect of the trucking business. So it's great to, load up my truck here in Bakersfield and head off down the road and go up Highway 58. Don't get in a 43 car pileup that happened yesterday, but miss that. But continue eastbound, and you end up in well, let's say Chicago. It's going to be imperative that your lender, he's going to want to know if you have a backhaul, if you have a way of hauling back to get your next load or hauling to a location where your next load is. So these things can all be explained. But one thing that you've really got to do is you've really got to concentrate on the margins that you have in your business, the seasonality, or the labor intensity that can hurt that business's credibility. Again, not in the top five, but important. One of the things we see a lot, and it was tough for me to leave this out of the top five, is because oftentimes lenders or borrowers, excuse me, will come in and they will either want or think that they need the wrong loan, the wrong lender, or another need. So potentially the wrong need. So mismatching, your loan purchase, your loan purpose, your loan product with the wrong lender is important. We have specific lenders who have limit amounts. They will lend up to $50,000 and that's it. Up to $50,000, they're fantastic. They're great. But don't ask them for $51,000 or you have mismatched your loan, your lender, your loan product. So, some of the other more common areas is what we see individuals coming in wanting short-term debt for long-term assets. So by that, you're looking for short-term of about 3 years or so, 3 or 4 years. You see a lot of that with some of this really dangerous internet or online lending. But using short-term debt for long-term assets, if I'm buying a delivery vehicle for my business that costs $80,000, I don't want a 3-year loan. I want a loan that's going to go over the life of that particular asset. I want to pay it off over, 8 or maybe even up to 10 years if I'm going to employ the asset that long. Now, if you do the flip side of that, you also really don't want to have short-term assets for a long-term loan. So if I'm getting working capital, do I really want to pay for working capital and startup expenses and advertising and money to get my business started over a 7 or 10 year loan? In many cases, not. I'm going to want to pay for that over a shorter period of time. And that permanent working capital, establishing that working capital base really helps in the long run. We'll see also people will want to, and it's, I think, human nature to only pay for what you're using. So, they only want to pay for the interest on the amount of money they're borrowing. And credit lines are great for that. But, oftentimes, most of the lenders we deal with, they really want existing businesses with historic cash flow and proven results before they go into the lines of credit or credit lines. So generally, a term loan is generally all you have available. So the other common error on the wrong loan lender or the wrong need is not understanding all the loan terms and cash flow aspects. And that can get back to some of the fintech loans and some of the online lenders to where you might not even understand what the interest rate you're paying. You might know that you have a daily payment that comes out of your checking account, but really that boost in cash at the very beginning of that, over the term of that 18-month to 36-month loan, can really drag the business down by the continuing everyday bleeding of that particular payment. So it's really important to understand the cash flow aspects of that. So let's start with my top five. My top five is number five is not seeking advice. Um, I know what you're saying. You're saying, okay, Kelly, you're with a technical service provider providing free service to businesses in Kern, Inyo, and Mono counties, and also part of the region, Central California region, where I can get this particular service. Sure, you're going to say there's too many people not seeking advice. Well, I'm going to tell you, those of you that just says, I'll apply and see what the bank says, you've probably just burned a bridge at one of the banks when that might be the bank that is best and most likely to provide you funding. So the result can be you actually missed a lender fit for your particular business. There are errors, I hate to use a tennis term on you, but there are unforced errors where you might have some mistakes in there that immediately your lender will decline that particular application. And it also puts you in a weaker negotiating position. Always prepared borrowers win better terms. That's just how it works, even with the numbers in the situation. So, being a prepared borrower is what we like to see come out of the SBDC. So, I really encourage you to seek out the advice and to use what we or other technical assistant providers know. My number four is the need for an equity injection. So we see a lot of times a misconception that the bank will finance 100% of the project cost. So that's a misconception. Um, another thing is that there's a misconception that the equity injection has to only be cash. If you've accumulated assets, that can be used also for the equity injection. And by equity injection, I'm referring to down payment. So really 100% financing, whereas I've seen it happen. I've seen about everything happen, I think, in small business financing. It can happen, very, very limited applications, very, very small chance of a bank funding 100% of the project. So you're going to need a down payment or equity injection, and by doing so, you can inject both assets that you've attained for that particular business that work in the business or cash. An alternative source is one of our favorites around here is that doesn't get utilized hardly ever, and we're going to really try to really make a push, and that is using like a crowdfunding or potentially something specific like Kickstarter crowdfunding. So having a project that funds in that all of a sudden is cash that gets injected in the business that can leverage. We've worked recently on the City of Bakersfield entrepreneurship grants. Those were nice because you had a grant of, say, $10,000. All of a sudden, your lender counts that the very same as cash that you're putting into that particular business. So there is a need for the injection. A misconception can be what is going into it in addition to the resources and the sources that are out there. So, in that particular thing, you see the skin on the game a lot. I like to view it as lenders like to view a lending transaction as a partnership. They want to go in business with your particular business. They want to provide you the funds, but they want you to have your part there in addition to them supplying their part, which is the funding. Number three is challenging personal credit. Now, one thing that we don't talk about in great detail today, at least, but I'll mention now, is that, you know, small business funding takes time and time goes by pretty quick. I mentioned it's already January 28th, 2026 today. And your dry January is almost over, and your no buy January if you're participating in those things. But alongside of things is that time goes by quickly. If you have a challenging personal credit history right now, now's the time to get it fixed. You can get those repaired in a relatively short period of time. We've had some great success stories at the SBDC with businesses who have gone through bankruptcies and immense personal credit issues by taking time to get those fixed. So really, time is on your side in a lot of these aspects. So, you know, the pitfall is personal credit is going to impact you on your business loan. That's just something that's going to happen. I mentioned also the personal guarantees that's going to happen. So your personal credit and the credit history can drive interest rates, for example. You could be paying a higher rate, but more importantly, for many of the lenders that we have, is not the fact that they might require more collateral, but also your odds of being approved are enhanced by having better credit. So some of the frequent mistakes are going to be, late payments, having too many files open, too many reviews, and not removing credit reporting errors. It's mind-boggling how many credit errors we see on people's credit histories, and it's something that they were not aware of. So that can be something, but really repairing any bad credit in the past, it's something that takes a little bit of time, but it is something that really is going to help you potentially in the long run. Number two, confusing profit with cash flow. A lot of people will come in and say, "Hey, my business is making money, so I think I'll qualify." Where the reality is your profit and loss statement obviously in many cases doesn't equal your debt service capacity. And I think we focused this 2 weeks ago on a webinar. Isn't that wonderful? Debt service coverage ratio is already back. Um, so, lenders will focus on the debt service coverage ratio. And if you want more information on that, go to last webinar number 368 on our YouTube channel, not net income. So also what they'll look at is they'll look at non-cash expenses. So when we get into cash flow, we're looking at cash expenses, but non-cash expenses, owner draws, and timing differences really do matter. So borrowers that pass the owner business test but failed the credit committee test is something that you'll see as a typical outcome. So I'm profitable, I'm doing well with my business, but my lender will not lend on me based on not understanding the difference between that profit and that cash flow. And number one is the financial readiness bungles, as I call it. It's applying before the business is financially ready. And really it's nice to get out there. Oh, I have a typo. It's really nice to get out there and get your financial information out there, but outdated or incomplete financial information is not going to give you the information for a lender to make a decision. By not being able to demonstrate that it's going to cash flow, your project is going to cash flow to a cash flow lender is not being prepared. Tax returns that don't align with some of your internal profit and losses. We do see that. Profit tax returns say something. Profit and losses that you're turning in at the same time don't say something. Just show the financial institution that you're dealing with that you're not ready. So weak, inconsistent revenue trends are another one. And so why is this a deal killer? Is lenders will tell you all day long that they don't lend on optimism. They lend on predictability, and without having bullet ready, bulletproof financial information, then you're not loan ready. Okay, looks like we are getting low on time. So if you have questions, we're going to be going through those. Just be know that there are so many other funding options that are available rather than loans. Um, so we really like to look at those potentially, and really one of the things we like to look at are some other factors in addition to these wonderful alternative funding options. We like to look at some of the other things as well. So look at some of the financial options if you don't think you're ready for funding right now. And other key tips are, you might not be ready for the funding you want right now, but try to find funding in order to meet your cash flow needs now to where you can get the business stable or grow your particular business to get that particular loan. We've seen a lot of clients over the years that use credit cards, and credit cards aren't the worst things for your particular business. There are many other loan instruments online that are in merchant credit accounts that can be far more damaging to your business than those, particularly if you can find the low interest rate ones or no interest rates while you're able to consolidate and get everything in order. So a couple of the other things missing out is overstating your financial projections. Kind of talked a little bit about that. We talked about poor documentation or sloppy packaging. Here's another one that I struggled almost to put in the top five, and that's waiting too long to apply. Sometimes businesses apply too soon. Other times they wait too long until the business is already distressed. And it is harder to get a loan for a distressed business that doesn't have a good game plan or be able to show how they're going to become undistressed. So if you're having a cash crunch, a decline in sales, or vendor payments that are coming in a little bit slower than you would prefer, it's really kind of those are common signs, and it's really kind of imperative to try to get that taken care of and try to find funding immediately. And really, some lenders do use a scorecard, a lender decision scorecard. And here is a quick analysis of what one of those might look like. But the importance of the scorecard is to show you where the weight is. And the weight is going to be on debt, on cash flow and debt capacity, and on your financial documentation and quality on if your lender can trust the numbers. They've got to get to that point to where they can trust the numbers. So that's kind of a scorecard that kind of some will throw out. We could have, with time, we could have got into some of the loan rejections per the lenders. You'll see almost always on that particular list is going to be the inconsistent nature of cash flow. And when you have a cash flow forecast, one that looks like this, it's always great to have the assumptions to explain how it's going to work. So it's great to have the numbers in there. And if you have historic numbers, that's even better because you have historic results to back it up and to move on to those particular numbers. There's information for me. You can contact me, send me an email. There's my phone number as well. Um, we can chat later or again, but really, let's stop this presentation. Let's stop this PowerPoint madness and get in and see what questions you might have for us today. In jumping into the chat box with only a few minutes left, Maureen has put in here the items that she thinks are necessary and really helpful for you. Those include today some of the things such as of potentially, yes, your manufacturing links, your small business survey optimism, the VITA program, some good feedback from that. Also, the YouTube channel, Google results, and copy of the slides. Hey, we sent you a copy of the webinar. We'll send you a copy of the webinar a few days later with all the resources. If you want slides, yes, sure, send me an email on that. So no questions there today. Let's go and see if there's anything in our Q&A box, of which I do not see anything. So no questions today. You guys are pretty quiet today. So I guess that's going to wrap us up. It is time. Thank you for joining us for webinar number 369. We'll be back next week on webinar Wednesday number 370. And we will get into some of the things that Israel mentioned specifically about manufacturing with our special guest presenter next week, Mr. Doug Waterman. So for our producer, Maureen Busher-Dang, I am Kelly Bearden. Thank you for joining us. We'll be back next week. Bye-bye, everybody.